Does your salary disappear before the month even ends? You check your balance on the 28th, and somehow you're already at zero. Surprise. But honestly, this isn't bad luck. It's the most common and most dangerous financial mistake people make. And almost nobody talks about it. Here's what's actually happening. When money sits in your account, it feels endless. So it slowly bleeds out. Food delivery, impulse buys, weekend plans, until all that's left is regret. The fix? It's called pay yourself first. The moment your salary hits, automatically transfer 20% into a separate savings account. Done. Now live on the remaining 80%. Simple rule. Future you gets paid before anyone else does. Let's make it real. Salary of 30,000 rupees? Move 6,000 aside immediately. That's 72,000 in a year, without changing a single habit. And if you invest that, in 10 years, you're looking at 13 to 14 lakh rupees. From one small, automatic decision. Quick question. If you lost your job tomorrow, or a medical emergency hit your family tonight, how many months of expenses do you actually have saved up? If you don't know the answer, this video is exactly for you. Most people skip straight to investing, SIPs, stocks, crypto, without keeping a single rupee aside for emergencies. And then when life happens, they either take a loan or break their own investments. Both options hurt you. You lose money either way. An emergency fund is 3 to 6 months of your total monthly expenses sitting in a separate, liquid account. A fixed deposit or a high-interest savings account works perfectly. This money has one rule. Do not touch it unless there's a real emergency. Not a sale, not a vacation. A real emergency. Build this first. Invest after. Monthly expenses of 25,000 rupees. Your target is 75,000 to 1,50,000. That's your safety net. Save 10,000 a month and you're there in 8 to 15 months. After that, invest with full confidence because now no emergency can touch your wealth. End of the month and you're staring at your account thinking, where did it all go? No big purchases. No luxury splurges. Everything felt normal. And yet, zero. If that hits close to home, you need to hear this. Managing money without tracking it is like driving with your eyes closed. You genuinely don't know where it's leaking. Small things, food delivery, random subscriptions, one-click impulse buys, none of them feel like much. But together, they quietly dig a hole in your account every single month. Try the 50-30-20 rule. 50% of your income goes to needs, rent, food, transport. 30% goes to wants, dining out, entertainment, things you enjoy. And 20% goes straight to savings. Track it with an app, Jupiter, FE, or even a simple Excel sheet. Give it just 2 minutes a day. That's it. Here's what's wild. Just starting to track, the average person finds 15 to 20% in savings they didn't know they had. Once you see where the money goes, control comes naturally. See it first. Cut it second. Don't fire in the dark. Got a raise? Salary went up? Great. But did your rent, your restaurants, your wardrobe, and your subscriptions go up at exactly the same time? Congratulations. You just met lifestyle inflation. And it's been quietly robbing you for years. This is the sneakiest trap in personal finance. Income goes up. Lifestyle goes up. But savings? They stay exactly the same. 5 years pass, your salary doubles. And somehow, you still have nothing saved. Because every raise comes with upgraded expectations. More money in, more money out. The gap never closes. Here's the one rule that changes everything. Every time you get an increment, take 50% of that raise and immediately put it into savings or investments. The other 50%? Enjoy it. Upgrade your life. You deserve it. But spending the entire raise on lifestyle? That's not a reward. That's stealing from your future self. Got a 5,000 rupee raise? Put just 2,500 rupees into a SIP. At 12% returns over 10 years, that's 5.8 lakh rupees. From one raise, one decision. Now imagine doing this every single year. The numbers get serious, fast. Start today, not next month. Today. How many EMIs are you running right now? Phone, laptop, bike, maybe even a sofa? If 40 to 50% of your salary is going into EMIs every single month, stop what you're doing and watch this. Because this is a serious problem. EMIs are a comfortable trap. It feels like it's just 2,000 a month. But stack 5 or 6 of them together and suddenly it's a massive burden. And the moment one ends, a new one begins. This cycle never breaks on its own. Never. Golden rule, your total EMIs should never cross 30% of your salary. Above that, you're in the danger zone. So how do you fix it? Use the snowball method. Kill the smallest EMI first. Take that freed up money and throw it at the next one. Clear them one by one until you're finally free. Close one 5,000 rupee bike EMI. Take that same 5,000 every month and invest it for 5 years. That's over 4 lakh rupees. EMIs give you the illusion of owning things. But in reality, they're quietly eating your future purchasing power, 1 month at a time. Not tomorrow. Not next month. Today. You pay the minimum on your credit card and think, at least I paid something, right? Wrong. The bank makes most of its money from people who do exactly that. You are their favorite customer. And trust me, that is not a compliment. Credit card interest rates in India sit between 36 to 42% per year. That sounds like a number until you actually do the math. Leave 10,000 rupees outstanding for 1 year. It becomes 14,200. You paid 4,200 rupees in interest. For nothing. You bought nothing extra. You got nothing extra. Just 4,200, gone. There's only one rule. Pay your full credit card bill before the due date every single month. 100%. No exceptions. Minimum payment is a trap deliberately engineered by the bank to keep you hooked. And if you cannot pay the full bill, then you simply cannot afford that thing right now. That's it. That's the rule. Use your credit card, grab the rewards, the cashback, the travel points, all of it. But bring that balance to zero every single month. That's how smart people make credit cards work for them. Everyone else? They're working for the credit card. So which side do you want to be on? You don't have term insurance yet? Think about it for a second. If something happened to you tomorrow, what would the people depending on you actually do? That's an uncomfortable question. But avoiding it creates a future that's even more uncomfortable. Insurance feels boring. It gives no returns. So people ignore it. But here's the thing. Insurance is not about returns. It's about protection. Until you need it, it feels like a waste. The moment you need it, it's everything. 2 things you need to do right now. Get term life insurance and health insurance. A 1 crore term cover at age 25 costs just 600 to 800 rupees a month. And without health insurance, one hospitalization can wipe out years of savings. Overnight. Also, avoid ULIPs and endowment plans. They're neither good insurance nor good investments. Don't mix the two. 700 rupees a month for a 1 crore cover. That is less than a single Swiggy order. Invest later, protect first. Once your foundation is secure, you can build everything on top of it. Go to Policybazaar right now. Takes 10 minutes to compare and buy. Do it today. Renting is a waste. You should own your home. If you've heard this once, you've heard it 1,000 times. Parents, relatives, neighbors, everyone says it. But is it actually the right financial move? Short answer, it depends. Long answer, keep watching. People buy homes on emotion, pride, security, social pressure. The financial math never gets done. They take on a heavy home loan, lock themselves in for 20 to 25 years, and convince themselves it was the best decision, without ever actually checking if it was. There's a simple test for this, the price to rent ratio. Take the property price, divided by the annual rent for that same property. If the ratio is below 200, buying makes sense. Above 200, rent it and invest the difference. In most Indian metros, this ratio sits between 300 and 400. Do the math before you sign anything. 1 crore flat, 25,000 rupees monthly rent. That's a ratio of 400. So instead of paying a 70,000 rupee EMI, pay 25,000 in rent and invest the remaining 45,000 every month. Over 20 years, that investment could actually exceed the value of the flat itself. Calculate first, feel later. Owning a home is not the goal. Financial freedom is the goal. Words market crashed 20%. And you paused your SIP? That's the most expensive mistake you can make. JAHAS Meman, welcome to Series 2, Investing Mistakes. Episode 9 of 30 Finance Mistakes. Today, stopping your SIP when markets fall. When markets drop, panic hits. People stop SIPs thinking they're protecting their money. But here's the truth. A falling market means your money buys more units at a lower price. You're shopping in a sale and choosing not to buy. This is called rupee cost averaging, the entire superpower of a SIP. When markets are down, you get more units for the same money. When markets recover, and they always do, those extra units explode in value. If anything, a crash is the time to increase your SIP, not pause it. March 2020, COVID crash. Markets down 40%. Those who kept SIPs running, over 100% returns by December 2021. Those who stopped, they locked in losses. Discipline beats intelligence in investing. Always. Like, share, subscribe, episode 10 tomorrow.
All your savings in a fixed deposit feels safe. But here is the uncomfortable truth about FDs. JAHAS Meman, episode 10, 30 Finance Mistakes. Today, over-relying on fixed deposits. FD gives you around 7% return. Inflation in India runs at 5 to 6%. Your real return? Just 1%. Meaning, your money is barely keeping up with rising prices. You're not building wealth. You're standing still. FDs are not bad. They are just for the wrong purpose. Use FDs for your emergency fund and short-term goals. For long-term wealth building, 5 years or more, equity index funds are far more powerful, boring, consistent, and historically unbeatable. 1 lakh for 20 years. FD at 7% becomes 3.9 lakh. Nifty 50 index fund at 14% becomes 13.7 lakh. Same money, same time. 3.5 times more. Right tool, right purpose. FD for safety. Equity for growth. Like, share, subscribe.
All your savings in a fixed deposit feels safe. But here is the uncomfortable truth about FDs. JAHAS Meman, episode 10, 30 Finance Mistakes. Today, over-relying on fixed deposits. FD gives you around 7% return. Inflation in India runs at 5 to 6%. Your real return? Just 1%. Meaning, your money is barely keeping up with rising prices. You are not building wealth. You are standing still. FDs are not bad. They're just for the wrong purpose. Use FDs for your emergency fund and short-term goals. For long-term wealth building, 5 years or more, equity index funds are far more powerful, boring, consistent, and historically unbeatable. 1 lakh for 20 years. FD at 7% becomes 3.9 lakh. Nifty 50 index fund at 14% becomes 13.7 lakh. Same money, same time, 3.5 times more. Right tool, right purpose. FD for safety, equity for growth. Like, share, subscribe. This stock is a sure thing. I am putting everything in it. Famous last words. JAHAS Meman, episode 11, 30 Finance Mistakes. Today, concentration risk. When you put everything into one stock, your entire financial future depends on one company making the right decisions. One bad earnings report, one scandal, one global event, and your portfolio can drop 50, 60, even 70% overnight. The rule is simple. Never put more than 10% of your portfolio into any single stock. Spread across sectors, banking, tech, pharma, FMCG. And if picking stocks feels overwhelming, an index fund solves it automatically. One fund, 50 top companies, zero research needed. Nifty 50 Index Fund, 500 rupees a month on Grow or Zerodha. Instant diversification across India's top 50 companies. No tips, no research, no stress. Don't bet on one horse. Own the whole race. Like, share, subscribe. This fund gave 65% returns last year. And you invested. Right at the top. Classic. JAHAS Meman, Episode 12, 30 Finance Mistakes. Today, chasing past returns. This is called recency bias. Our brain assumes what happened recently will keep happening. But in markets, last year's top performer is often this year's worst performer. You buy at the peak and ride it all the way down. How to actually choose a fund? Ignore the 1-year return completely. Instead, look at consistency over 5 to 7 years. Did it beat its benchmark most years? Expense ratio under 1% in direct plan. Fund manager track record. These 3 things matter. Last year's chart does not. Every year SEBI data shows the top 5 funds of year 1 rarely appear in top 5 of year 2. Check ValueResearch or Morningstar, not just the return chart. Invest on data, not on hype. Be the smart money. Like, share, subscribe. Did you buy your mutual fund through a bank or an agent? They're taking a cut every year, and you do not even know it. JAHAS Meman, Episode 13, 30 Finance Mistakes. Today, regular versus direct mutual fund plans. Every mutual fund has 2 versions, regular and direct. In the regular plan, a hidden commission of 0.5 to 1.5% is paid to the agent or bank every single year. It comes straight out of your returns. Silently, automatically, forever. The direct plan is the exact same fund, same stocks, same fund manager, but no middleman commission. Lower expense ratio, higher returns. You can switch to direct plans on Zerodha Coin, Grow, or directly on the AMC website. Takes 10 minutes. Completely free. 10,000 a month for 20 years. Regular plan, 97 lakh. Direct plan, 1.07 crore. That is 10 lakh difference from one simple switch. One click, 10 lakh saved. Switch to direct today. Like, share, subscribe. Market is too high right now. I will invest when it corrects. You have been saying that for 2 years. Have you not? JAHAS Meman, Episode 14, 30 Finance Mistakes. Today, trying to time the market. Market timing, buying the bottom and selling at the top, sounds smart. But no one, not even the world's best fund managers, can do this consistently. Waiting for the right time is just fear dressed up as strategy. There is a famous saying, time in the market beats timing the market. The longer your money stays invested, the more compound interest does the heavy lifting. Start today. Any amount. Any market level. SIP takes care of the rest automatically. Perfect entry points do not exist. 1 lakh invested in Nifty in 2004, worth over 22 lakh today. The people waiting for the right time in 2004? Still waiting. The best time was 10 years ago. The second best time is now. Like, share, subscribe. My friend made 5x in crypto. I am putting my savings in too. Before you do that, hear this. JAHAS Meman, Episode 15, 30 Finance Mistakes. Today, crypto FOMO. Bull markets make everyone look like a genius. When crypto was going up 10x, the stories spread everywhere. But the data tells a different story. Over 80% of retail crypto investors lose money, especially those who buy during hype cycles at the top. Crypto is not necessarily bad, but FOMO investing in anything is. If you want exposure to crypto, treat it as a high-risk speculative bet, maximum 5% of your portfolio. Only money you can afford to lose completely. Zero leverage. Zero borrowed money. No signal groups. No hot tips. Bitcoin fell 80% in 2022. Most people who invested during the hype of 2021 are still underwater today. Your friend's 5x story? Ask them about 2022. Invest in what you understand. FOMO is not a strategy. Like, share, subscribe.
You invested and then completely forgot about it. Set it and forget it, but also never check if it is still working. JAHAS Meman, episode 16, 30 Finance Mistakes. Final investing episode today. No portfolio review. Markets move. Your equity grows faster than your debt. Slowly, your asset allocation drifts. You're taking more risk than you planned. And some funds quietly underperform for 3 years straight. And you would never know because you never looked. Review your portfolio once a year. That is it. Check 2 things. First, is your equity-to-debt ratio still where you want it? If equity grew too large, rebalance. Second, has any fund underperformed its benchmark for 3 or more years? If yes, consider switching. Annual review. 30 minutes. That is all. Set a reminder right now. Every January 1st, review my portfolio. 1 hour a year can mean lakhs of rupees more at retirement. That is the highest ROI activity you will ever do. Review. Do not react. Big difference. Like, share, subscribe. Series 3. Mindset Mistakes starts tomorrow.
My friend got the new iPhone. I cannot be seen with a 2-year-old phone. Sound familiar? JAHAS Meman, welcome to Series 3, Mindset Mistakes. Episode 17 of 30 Finance Mistakes. Today, the social comparison trap. Keeping up with others' lifestyles is called keeping up with the Joneses. The problem? You do not know their full financial picture. They might be drowning in debt, living on their parents' money, or maxed out on credit cards, just to look good. Change your scoreboard. Stop measuring success by gadgets, clothes, or restaurants. Start tracking your net worth instead, everything you own minus everything you owe. That number growing month on month, that is the real flex. Nobody sees it. But it is the only number that actually matters. Wealthy people are often the most boring-looking ones in the room. Used car, simple phone, plain clothes. Their bank accounts just look different. Own your game. Play your own scoreboard. Like, share, subscribe. Episode 18 tomorrow. Finance is boring. It is not for me. That single belief could cost you crores over your lifetime. JAHAS Meman, Episode 18, 30 Finance Mistakes. Today, avoiding finance because it feels boring. The reason finance feels boring? Nobody taught it well. School gave us trigonometry. Not how to invest. Not how to pay taxes. Not how to build wealth. So it feels foreign and uncomfortable. And we avoid what feels uncomfortable. Reframe what finance means. Finance is not maths. It is freedom. Understanding money means choosing when to work, where to live, what to do with your time. 15 minutes a day, this channel, a book, a podcast. 1 year from now, you will not recognize your financial life. 5,000 a month, 30 years, 12% return, 1.76 crore. Tell me that is boring. That is compound interest. And it works whether you find it interesting or not. You are watching this. You have already started. Like, share, subscribe. Was money a taboo topic growing up in your house? Then you inherited financial habits, not just values. JAHAS Meman, Episode 19, 30 Finance Mistakes. Today, repeating your parents' financial cycle. Our parents did the best they could with the information they had. But most did not have access to mutual funds, index investing, or financial literacy content. So we grow up copying their habits, gold, FDs, avoiding stocks without questioning why. You have something they did not, information. Use it. Build a new playbook, emergency fund, term insurance, direct index funds, clear financial goals. And then, teach your parents. Reverse mentoring. Show them the numbers. One person in a family who learns finance can change the entire family's financial trajectory. You are the generation with YouTube, Grow, and free financial content. That is a privilege your parents did not have. Use it. Break the cycle. You have the tools. Use them. Like, share, subscribe. Invest 10,000, double it in 3 months. If your heart moved even slightly, this video is for you. JAHAS Meman, Episode 20, 30 Finance Mistakes. Today, get rich quick schemes. These schemes work because they are designed to work briefly. Early investors get paid using new investors' money. That is a Ponzi scheme. The promoters disappear. The majority loses everything. India loses thousands of crores to these every single year. One mental filter to protect yourself forever. If it sounds too good to be true, it is. Legitimate wealth takes time. Warren Buffett, the world's greatest investor, averaged 20% per year over 60 years. If nobody can guarantee 20%, how is someone promising 100% in 3 months? Borrowing 10,000 a month, 25 years, 12% return is equal to 1.89 crore. No excitement, no drama, just real compounding wealth. That is what actually works. Borrowing is beautiful in investing. Protect your money. Like, share, subscribe. I just want to save more money. That is not a goal. That is a wish. And wishes do not have plans. JAHAS Meman, Episode 21, 30 Finance Mistakes. Today, vague financial goals. Without specific goals, you have no idea how much to save, how long to invest, or how much risk to take. And when markets drop, you panic sell because there is nothing concrete anchoring your decisions. Goals are not just motivation. They're your anchor when everything feels uncertain. Use SMART goals: specific, measurable, achievable, relevant, time-bound. Set 3. 1-year goal. 1 lakh emergency fund by March 2027. 5-year goal. 5 lakh for a car by 2031. 10-year goal. 50 lakh retirement corpus by 2036. Now backward calculate the monthly SIP needed. Now you do not have a wish anymore. You have a plan. Research shows people with written goals are 42% more likely to achieve them. Not a coincidence. Writing makes it real. Real makes it actionable. And actionable actually changes your life. Write 3 goals down today. Right now. Not later. Not tomorrow morning. Right now, pause this video and write them. Like, share, subscribe. Taking a loan to give a big wedding gift? The wedding will be forgotten. The EMI will not. JAHAS Meman, Episode 22, 30 Finance Mistakes. Today, borrowing for social appearances. Social pressure around money is a real epidemic in India. Weddings, group trips, festivals, gifts. Log kya sochenge has become one of the most expensive phrases in our culture. We go into debt to look wealthy instead of building actual wealth. Learn 2 things. First, the word no. I cannot afford it this month is a complete sentence. Second, your financial reputation matters more than your social reputation. One compounds. The other costs money every month. 3,600 rupees spent on social approval, invested instead for 10 years, becomes something real. No is a financial superpower. Learn it. Like, share, subscribe. Do you avoid opening your bank app because the number scares you? Avoidance does not make the number better. It just makes the anxiety bigger. JAHAS Meman, Episode 23, Final Mindset Episode. 30 Finance Mistakes. Today, Financial anxiety. Financial stress is real, and avoiding it feels like relief. But avoidance is just delayed pain with interest. The debt grows. The savings do not build. The problem compounds. All while the anxiety gets worse, not better, because nothing is actually changing. One small step changes everything. Calculate your net worth today. Write down everything you own, savings, investments, any property. Subtract everything you owe, loans, credit card dues. Whatever number you get, now it is known. Known is manageable. Unknown is terrifying. Anxiety comes from uncertainty. Knowledge kills uncertainty. Negative net worth? Now you can make a plan. Zero? Now you build. Positive? Now you grow. Any number is better than no number. Calculate your net worth today. That is your first step. Like, share, subscribe, Series 4, tax and credit tomorrow. The government is literally offering to reduce your tax bill by up to 46,800 rupees a year. Most people do not claim it. JAHAS Meman, welcome to Series 4, Tax and Credit Mistakes. Episode 24 of 30 Finance Mistakes. Today, Section ATC. Most salaried people either do not know about ATC or they rush to fill it up in March with any random product. Both approaches cost you money. Tax planning is a year-round activity, not a March emergency. Section ATC lets you deduct up to 1.5 lakh from your taxable income. Best options: ELSS mutual funds, equity returns plus tax saving, only 3-year lock-in. PPF, safe, tax-free maturity. NPS, additional 50,000 deduction under ATC-CD. Check your EPF first. It already counts towards ATC. Then fill the rest with ELSS. 30% tax bracket. Invest 1.5 lakh in ELSS. Save 46,800 in taxes guaranteed. Plus equity returns on top. That is literally free money. Plan in April, not March. Your future self will thank you. Like, share, subscribe. My tax is already deducted at source. Why do I need to file a return? Let me give you 5 reasons. JAHAS Meman, Episode 25, 30 Finance Mistakes. Today, skipping ITR filing. People assume ITR is only for people who owe tax. That is wrong. Not filing ITR means no tax refund, no loan approval, no visa application, no high-value transaction record. And if income tax notices a gap, penalties can follow even on zero tax income. If your income is above 2.5 lakh, file your ITR every year. No exceptions. It takes 30 to 45 minutes on incometax.gov.in, completely free. Your Form 26 as and AIs are pre-filled. Even if your tax liability is zero, file it. It is your financial passport. Paid extra TDS and never filed ITR? That refund is sitting there unclaimed. The government will not send it to you. You have to claim it. File your ITR. It is free, fast, and yours. Like, share, subscribe. Everyone is using the new tax regime, so I did too. That sentence could have just cost you 30,000 rupees. JAHAS Meman, Episode 26, 30 Finance Mistakes. Today, picking tax regime blindly. India has 2 tax regimes, old and new. New regime has lower rates, but removes most deductions, ATC HRA, home loan interest. The right choice depends entirely on your specific income and deductions. What is right for your colleague could be wrong for you. Simple test: if your total deductions are high, ATC maxed, HRA claim, home loan interest, old regime likely saves you more tax. Minimal deductions, new regime might be better. Use the free calculator on ClearTax or Tax to win 5 minutes, shows you exactly which to pick. 12 lakh salary with ATC HRA. NPS, old regime saves 34,000 more than new regime. Same income, different choice. 34,000 rupees difference. Calculate. Do not copy. This is a personal decision. Like, share, subscribe. You sold your mutual fund, made a profit, great. Did you factor in the tax you owe on that profit? JAHAS Meman, Episode 27, 30 Finance Mistakes. Today, capital gains tax. Most investors do not think about tax when they sell. Then ITR season arrives, unexpected tax bill. Selling at the wrong time can cost you significantly more tax than waiting just a few more months. For equity funds held less than 1 year, short-term capital gain tax is 20%. Held more than 1 year, long-term capital gain is 12.5%, but the first 1.25 lakh is completely tax-free every year. Use this. Harvest 1.25 lakh profit every year. Reinvest it. Reset your cost basis and pay zero tax. Selling equity funds after 1 year instead of before saves 7.5% in tax on gains. On 5 lakh profit, that is 37,500 saved. Just by waiting. Tax-smart investing is equal to same portfolio, more money. Learn the rules. Like, share, subscribe. Do you know your CIBIL score right now? If you do not, that is already a problem. JAHAS Meman, Episode 28, 30 Finance Mistakes. Today, ignoring your credit score. Your credit score ranges from 300 to 900. A score above 750 gets you the best loan rates. Below 650, you either get rejected or pay significantly higher interest. On a 50 lakh home loan, a bad score can cost you 10 to 15 lakh in extra interest over 20 years. 4 things that build a great credit score. 1. Pay credit card bills in full, on time, every month. 2. Keep credit utilization below 30%. 3. Do not apply for multiple loans at once. 4. Maintain a mix of credit types. Check your score free on CRIF or BankBazaar monthly. Score 800 plus gets you 8.5% home loan interest. Score 650 gets you 10.5%. That 2% difference on 50 lakh is equal to 13 lakh extra paid over 20 years. Check your score today. Free. 2 minutes. Do not wait. Like, share, subscribe. My advisor recommended this fund, so I invested. Quick question. Do you know what your advisor gets paid when you invest? JAHAS Meman, Episode 29, 30 Finance Mistakes. Today, blind advisor trust. Most financial advisors and bank relationship managers in India are commission-based. They get paid more for selling certain products than others. This means their recommendation is shaped by their commission, not your best interest. It is not malicious. It is just how the system works. You have 3 options. 1. Use a SEBI registered fee-only financial planner. Flat fee, no commission, fully unbiased. 2. Learn the basics yourself. That is what this series is for. 3. Ask every advisor, what do you get paid when I buy this? A good advisor will answer immediately. A bad one will not. One question, what is your incentive here? Is the most powerful consumer protection tool you have. Use it every time. Every single time. Your money, your decisions. Ask the hard questions. Like, share, subscribe. 30 days. 30 finance mistakes. You just completed something most people never do. You actually learned about your money. I am JAHAS Meman, and this is the final episode of 30 finance mistakes that are silently making you broke. We covered 4 series: money basics, investing, mindset, tax, and credit. Each episode was one mistake that costs real people real money every single day. Now you know them. Most of India does not. Knowledge without action is just entertainment. So here is your action plan. Pick just 3 mistakes from this series that apply to you right now. Fix those 3 first. One good financial habit built is worth 100 videos watched. Start today. Not Monday. Today. And All 30 episodes are now combined into one complete video on this channel. Watch it, save it, share it. It is the most important finance video you will ever watch. Thank you for watching every day. See you in the next series. Like, share, subscribe.